Griffin here to talk to you about the question of the day. And the question that I am being asked is, what are reserves? Now, reserves are really just a way for you to show that you are a safe bet for a mortgage, that you know that you're ready and you can afford it. And this is how we're going to show it. So basically, reserves are based on the subject property that you are buying. It's based on the principal, interest, taxes, insurance, and any assessments. And what it is, we want to take that number and multiply it to say that you have that amount after everything is said and done. After you've paid your closing costs and your down payment, you will have this amount of money still in the bank. And that's what we want to show. We want to show that you're safe so that if anything were to happen, the bank knows that if something goes wrong, you can still cover your mortgage payment. So that's why we want to show that you have reserves. Now, the actual reserves that you are required, it depends on a few factors. It depends on the property that you're buying. So if you're buying a single family residence, typically they require 1 to 2 months of reserves. It really depends on your situation though. And let's say you are buying a larger unit, a multi-unit, and they will require you to have higher reserves. We want to show that, hey, if something goes wrong, you're not getting those monthly payments in, that you can still make your mortgage payment. So that's why reserves are really, really important. If you are looking at doing a jumbo loan, typically they require more reserves. So this is really just what you want to show and what you want to have in the bank, because we want to show that you're safe. So reserves are required, and this is what you need to know about them. If you got any questions, feel free to ask.